Well, I've been waiting on a more definitive sign for Quad 2. Quad 2 is growth with accelerating inflation, and I think we've now got that. The last 2 days, I've been spending a lot of time and energy just grossing up our net long positions in portfolios across the board in those positions that tend to do well within Quad 2, which typically is tech, consumer discretionary type things, industrials, materials, commodities, those sorts of things. Internationally, the best markets continue to be China, Taiwan, Japan, South Korea, Russia, Norway, Finland, and Denmark. And so we have some exposure to a lot of these types of things. But one of the other things that's just started to happen in the last couple of days is a breakdown on VIX, which, as you know, is the volatility measurement for the S&P 500, along with a breakdown on VXN, which is a volatility measurement for the NASDAQ. So we believe we're in the midst of what's called a chop. Chop just basically means that VIX is likely to trade between a certain level. However, it looks like it could be breaking down even farther than what the math this morning suggested might be happening. So that's good for price. So that's what allows us to increase long positions. Quad 2 is way different than Quad 3 or 4. Quad 3 is stagflation. Quad 4 rather is deflation. And this has been by far the most difficult trading year that I've ever dealt with, because we've switched from quad sequences a number of times. We've gone from January in a Quad 1, Quad 2 sequence to a collapse into Quad 4. There was a number of signals that allowed us to get out before the collapse, which we did, as you know. And then once we hit the bottom on Quad 4, we jumped into Quad 3, back into Quad 4, back into Quad 3, now into Quad 2. One of the other signals that's helping us to recognize that it's a Quad 2 type moment is that interest rates look to be done going down. Now that's significant. We've been in an environment where interest rates have been steadily declining for quite some time, but based on what the math is suggesting, it appears that, in fact, interest rates might not want to go below about 0.83% on the 10-year Treasury. At least that's what the math is suggesting right now. That's what we would call a higher low for this current cycle and this current sequence. And if we see the 10-year Treasury rate break out above 1.01%, well, then that just would confirm that that's where we're at. So what do you do in Quad 2? You buy tech, you buy consumer discretionary, you buy industrials, materials, the reflation type things, you buy commodities. Currently we're long corn, copper, wheat. We're using the commodity cycle as best as we can, dependent upon what the math shows, to allow us to enter into positions at a reasonably good price. And so therefore, it's just not a headlong. We just don't jump into it like crazy. But we've gone from about 85% cash down to about 65% cash in just 2 days. And we've got a number of positions that range anywhere from 25 basis points all the way up to well over 3% on equities and commodities. So we're increasing our risk position. And that's the thing to really recognize when you're dealing with a sequence or a phase change within the quad regimes that we have been. When you go from a Quad 4, Quad 3 type cycle where it's all about risk off, it's all about protection, it's all about sequencing your portfolio to minimize downside risk, into a Quad 2, potentially Quad 1 sequence, that becomes a very risk-on environment. And you don't have that until you see volatility measurements break down and until you see interest rates start to break out. And so those are the two things that we're watching right now. I'm going to share my screen with you real quick and just show you a couple of things that help to hopefully explain that. This is a picture of VIX, and you can see just literally it recently broke trend and now appears to be headed toward probably 19. If we get down to 19, I'll probably start to minimize some of the exposure depending upon the kind of beta risk that we have. Beta just is a measurement to help us identify how much risk in that position comparative to the S&P 500. But when I mentioned the chop earlier, what that means is that we anticipate the VIX to range or to chop somewhere between 19 and 26. And it may or may not do that very long. It may do that for an extended period. it may just completely break down and head towards mid-teens, which if it heads down in here into these mid-teens, that'll be awesome for U.S. equities, and you'll see us gross up portfolio positions very, very strongly within that kind of a cycle. And so, that being said, some of the positions that we've got on place right now are, in terms of commodities, that is, natural gas is certainly one of the commodities we have exposure to. Corn, which is and has been one of our core positions. Cattle and pigs, another core position. Wheat, which has been another core position for some time within the portfolio. Copper, which continues to signal higher highs. And, copper is a pretty smart metal in terms of economic growth and the kinds of things that we anticipate when in the midst of a Quad 2 cycle. As many of you know, the world has been shifting in terms of their viewpoints on the legalization of different forms of cannabis and things of that nature. The market for CBD oil is huge, and so therefore what you find from a medicinal standpoint for the use of these oils, not for the highs that so many people talk about, but the medicinal use of the oils is really tremendous within the marketplace, and it's got a lot of expansion. And so therefore one of the other commodities that we've added is in fact exposure to that, and I think that something like that could do really, really well going forward. We have tech in the portfolio as manifested by the NASDAQ 100, by a more broad technology position. Gaming, which has been something that has been completely blown up due to COVID, has changed its characteristics by a considerable amount. You can see that has moved up a fair amount. In the banking industry or brokerage industry, securities exchanges and capital markets, these are all exposures for a Quad 2 type cycle, along with consumer discretionary. And so these are things that we're going to be building, positions that we're going to continue to grow into as the math suggests makes sense. Internationally, as I mentioned, we want to buy on red as best as we can. Sometimes we don't get much red, so if the math suggests it makes sense, we might extend it and move forward. So this is China. This is Taiwan. Bought some Taiwan on red today, actually. Bought some China on red today. The Chinese consumer, which we own. Norway, which is having of course, great day, up over 3% on the day. Finland, same kind of scenario, looking very good. Russia is an oil play. That continues to do well. There's a number of oil and energy positions that I'd like to add. However, the math has not given me an opportunity to enter into that just yet, and so we have to spend a little bit of time being patient and waiting for the low end of the math range to actually allow us to enter into a couple of those spots. One of the other things that I want to show you is the US dollar. If in fact we continue to move forward within the political regime and we continue to see people like Janet Yellen come back into the fold and take over, it's highly likely the US dollar continues to get creamed. And so therefore, if it does, we're going to continue to see commodities expand in terms of their price, and we'll see the dollar go down in value. And so a way to express the US dollar with the exchange traded fund market is symbol UUP. For those of you who have a portfolio that allows a risk perspective of shorting positions, allows us to go against the grain, we are short the US dollar, and that's manifested in symbol UDN. And so the US dollar could have a long, long way to fall if in fact these MMTers, these modern monetary theorists, get into power, as it appears they may. And it's kind of hard to tell exactly how that US dollar might respond here in the near term as we're kind of figuring out the whole political spectrum. But it looks like that's likely to happen. So therefore, those are the things and those are the positions that are going to help us to get there. Some of you may be feeling as if you're missing out. Some of you may be feeling as if we're getting left behind by not being all in. recognize when you're risk managing a portfolio, one of the things that we're attempting to do is to minimize a strong downside movement. I understand the FOMO, the fear of missing out. But when you get an economic phase change that just starts to signal all the things that we're signaling right now, it's early in the game. And I do not feel in any way, shape, or form that we're missing out by not being fully invested. We'll get there. We'll get there dependent upon the ability to get the math ranges for entrance into more of the positions that we've already put in place and build out the core of our holdings as Quad 2 growth with accelerating inflation continues to develop. So don't lose sleep. Everything's going fine. It's going exactly according to plan. Of course, those plans get thrust and changed around depending upon the what we call micro quads and the pods and some of the things that happen within the daily range changes that the math will give us, dependent upon what's happened with volatility. But when you see volatility break down the way that we have, and when you see interest rates break out the way that it looks like they are breaking out, then we take advantage of that by appropriately building out the Quad 2 portfolio. One of the other things that we just started shorting today are U.S. Treasuries. When it looks as if interest rates are done going down, we don't want to own Treasuries. In fact, most bonds we don't want to own. What we do want to own are what we call yield curve steepeners. And we have that in the portfolio. That currently is one of our larger positions because it's very riskless. You don't see a lot of change in terms of price. But it is a valuable position when we have a steepening yield curve where the 2-year Treasury and the 10-year Treasury continues to steepen. And that's consistent with the expectation for strong economic growth, which is exactly what you get in Quad 2, growth with accelerating inflation. So that's where we're at. That's what we're doing. If you have any questions at all, or if you want to chat more specifically about the positions that we've put in place in your portfolio, by all means, let me know. Always happy to hear from you, 608-354-1977, or email chris@careformywealth.com. And as I said, I really do feel that this is the beginning stages of this Quad 2 cycle, which is going to present a lot of opportunity for growth. There will be ups and downs, as is always the case in markets, but now we can more readily take advantage of those downs versus being fearful of them, that they could in fact perpetuate a larger degree of volatility and really break down markets. It doesn't appear like that's the case at this point anymore. It appears that we might get that VIX chop, but now when that VIX chops to the upside, it's going to give us an opportunity to just buy things at a better price. So again, any questions, give me a call or an email. It's always good to hear from you. Thank you again for letting me work for you. So thankful to be able to do that, and hope you have an amazing rest of your day. God bless.